Great to have you on. So I know you say that now is the time for investors to know what they own and why they own it. Does that mean that all of this volatility from the past week is just noise in your view, that the base case is still the same?
Well, a lot of the volatility is trying to answer the question, is this really a growth scare, or is it just simply that there's some uncertainty on the path for future growth? We know that we got the Atlanta Fed saying the GDP now number down as much as 3% for the first quarter, and that's kind of a shocking thing. But a lot of that has to do with the variability of outcomes when it comes to trade. Domestically, we're still seeing a very high level of CapEx investment plan, but that takes time to come back into the marketplace. And so what we have in the intermediate period right now in the short term is a lot of outcomes that could be different, and the market doesn't like that type of uncertainty. So along those lines, we're seeing a lot of people rebalance their portfolios, I think de-risking. There's a lot of people that have been involved with the Magnificent Seven now turning into the Lag Seven, and they're wanting to reevaluate what risk looks like in their portfolio. So we're definitely seeing people come away from the more growthier but also riskier sectors of the market like consumer discretionary and technology and look for better valuations. And you can find those in places like healthcare and financials at this point in time, where you still see really strong balance sheets, very good companies that have strong growth potential, just not the same type of volatility that you're finding in those other growthier types of sectors of this market.
And just curious what you're making of today's market action, in particular after that jobs print came in nearly in line with estimates. We added 151,000. We were looking for 160,000, but that's pretty close. We had a slight uptick in unemployment as well, but we're seeing more selling than we saw initially off the back of that print. What does that tell you about how the market is viewing risks to the economy right now?
Well, at the moment, the longer-term risk is higher for longer interest rates. And so what this jobs report told us is that things are still pretty much okay when it comes to that soft landing picture. So I think it's really more of that vision that rates aren't going to go lower anytime soon. We know that there's a Fed meeting later this month, and they're likely to take no action. In fact, there is a picture where we could see rate reductions later in June and July, but we're still in the camp of only 1 or 2 interest rate reductions. And that means that the cost of capital stays a little bit higher, and that those companies are going to have to deal with that. That does impact that rate of growth for some of these companies as well. So again, coming back into a better valuation model where you can look inside of healthcare and find an average PE of around 18 to 20 versus the 30-ish that you're getting from most NASDAQ 100 companies, or even in the banking sector and financials where those PEs are closer to 14 to 15 and still see good growth metrics. That seems like an appropriate de-risking of a portfolio at this moment in time.
We did see a bit of selling in financials this week. Are you concerned at all that we're seeing a little bit of a recessionary trade that could continue to be a laggard for the financial stocks?
No, in fact, what we're seeing with the 10-year Treasury down around 50 basis points on a year-to-date basis is sparking a wave of refinancing. And so for those banks that have a really large portfolio in the mortgage book, they're actually, standing to do better in terms of that fee revenue over the next quarter or so. And if we do get a wave of deregulation, we could see a parabolic growth rate for some of these financial names as well. So in the short term, yes, a little bit of pain, but if your main concern is tariffs, a lot of these multinational banks are kind of immune because they're just simply facilitating the financing of these goods and services. They don't really have a higher cost of doing business when it comes to these tariffs being implemented. So if that's your main concern, this is a little bit of a tariff-proof sector where you can go and hide out in.
So then what do you make of the action that we're seeing in these financial names? I mean, financials right now are on track to be the second worst performer in the S&P over the last 5 days, and you've got JP Morgan down 9% for the week at the moment. I know that's one of your picks. Do you want to talk to us about your bull case there?
Yeah, absolutely. A little bit of a sell the news type of a rotation right now in financials, but still one of the biggest banks on the planet that's going to be facilitating a lot of business going forward. And with some deregulation and a better environment in terms of, lower rates on the 10-year Treasury, we could actually see more M&A business. That's obviously good for their investment bank segment. And also we could anticipate later this year a better IPO market that they'll benefit from as well. So we feel like this is a very high quality name that has a strong dividend yield at the same time, so you can get paid while you wait out some of this volatility. And there's every reason to believe that they're going to bounce back from this recent performance.
All right, Brian, we got to leave it there. Thanks so much for joining us this morning.